Markets are holding their breath. American stocks drifted in a narrow range today as investors pulled back from big bets ahead of the Federal Reserve's latest interest rate decision. Buyers and sellers were roughly in balance. Nobody wanted to be caught on the wrong side of what could be a market-moving announcement. This kind of pre-Fed drift is common. When the path of monetary policy is unclear, many investors simply sit on their hands, and the stakes are real. Not just the rate decision itself, but every word that surrounds it. Even a small shift in the Fed's language can send stocks and bonds sharply in new directions. So what exactly is the Fed deciding? The Federal Reserve sets the federal funds rate, the short-term borrowing rate for banks. That one number ripples through the whole economy. It shapes mortgage rates, car loans, credit card costs, and the returns that savers earn on deposits. When the Fed raises rates, borrowing gets more expensive, and economic growth tends to slow. When it cuts, credit loosens and activity often picks up. Right now, the Fed is navigating a difficult stretch, and that is exactly why markets are watching so closely. Inflation has come down significantly from the peaks of recent years, but it has not yet reached the Fed's 2% target. At the same time, the labor market has been showing signs of cooling. Fewer job openings, softer hiring in some sectors. Fed officials must weigh both of those forces simultaneously, keeping rates high enough to finish the fight against inflation without squeezing the economy so hard that it tips into a sharper slowdown. That is not an easy balance to strike, and the Fed's own officials have not all agreed on where things stand. That internal tension is part of why markets are on edge. Beyond the rate number itself, investors will be passing every line of the Fed's official statement. Chair Jerome Powell will also speak after the decision is released, and his remarks often carry as much weight as the decision itself. A single phrase, say a shift from higher for longer to something more open-ended, can reset expectations for rate moves months down the line. And when rate expectations move, so do stocks, bonds, and the dollar, sometimes quickly. The practical point here is straightforward. In the hours around a Fed decision, volatility tends to spike, not always because of the decision itself, but because of the language around it. If you hold positions in rate-sensitive assets like bonds, dividend stocks, or real estate investment trusts, this is a moment to pay close attention to the statement, not just the headline number. This briefing is brought to you by First Financial News, Clear, daily coverage of the economy and markets at firstfinancialnews.com.